that's an area that we're shifting our approach to, is to go further down the capital stack, reduce your risk, and still get the same or better returns. So I think that's the smart play in this kind of part of the market in housing.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Ben Fraser. Mr. Fraser is the Chief Investment Officer at Aspen Funds, an Inc. 5000 company, is responsible for sourcing, vetting, and capital formation for investments. Ben has prior experience as a commercial banker and underwriter, as well as working in boutique asset management. He's a contributor on the Forbes Finance Council and is also the co-host of Invest Like a Billionaire podcast. We're going to have fun today talking about the macroeconomic cycle, what we think has happened in 2023, where we think the economy is going in the future, and what asset classes you should be looking at today. Ben, welcome to the show.
Hey, thanks for having me. Looking forward to chatting.
Yeah, man, this is going to be kind of like a nerd out session here. We're going to talk some macroeconomics, talk about kind of where we think things are going here. We're recording this a little bit before it airs, so we're kind of rolling into the end of 2023. But before we kind of get into that, Ben, please share a little bit for the audience about your background and what you're doing with Aspen Funds.
Yeah, sure. Well, thanks for having me, and always love a good nerd out sesh. So this will be fun.
Yeah.
So I'm currently the Chief Investment Officer at Aspen Funds and been here for about 6 years, really helping find deals, vet deals, put together capital, and manage our portfolio. So that's what I do now. My background is actually in banking. So I kind of come from a commercial background, was a underwriter, a lender for a period of time, and learned a lot in that time frame. It was really cool experience to look under the hood of these successful businesses, successful owners, and really, one of the cool things I got to do was look at their personal finance statements to see exactly what they had and what they invested in and how they made their wealth. And so, one of the kind of common denominators was, of course, business ownership, owning businesses, but then two was real estate, and it just always piqued my interest. And I knew I didn't want to be in banking long term. It got a little bit depressing over time because you're only looking at the downsides, right? Because you don't have any upside as a bank. So it's just, what's the worst case scenario? And really was excited to jump more into the equity side of it and create opportunity, create upside. And it's been really fun.
Yeah, no, I love it, man. And yeah, you're right. It's if you can own a bank, that's fantastic. And what's cool is, in a lot of ways, we, working with investors, allow them to be the bank in a lot of different ways. Bring their capital in, leverage their capital, sometimes even lend their capital out. With some of these different structures that are out there. And I think it's just wild looking at the history of banking in the United States and the way the Federal Reserve was created. And ultimately, what that leads to, it leads to these cycles. And I often talk about the real estate cycle on our podcast, 18, 19 years. And, I think 2023, if we go back almost a year now coming into this year, there's a lot of anxiety. We started to see regional bank failures. Interest rates were starting to go up. Ben, if you don't mind, kind of walk us through, what we saw going into this year. And then we can kind of talk about where we think we are in the cycle today.
Yeah, absolutely. One little kind of side comment on banking. It's always been funny because, as lenders, you're taught to, evaluate all the risks. And, one of those risks is leverage. And, when it's a good time of the cycle, banks are very, go higher leverage. And right now they're not leverage out. But I remember one of my senior credit officers telling me, he's like, it's kind of interesting where we get all negative when something goes above, say, 70% leverage at that point. But no one really thinks about the fact that banks are levered 90%, 10 to 1 usually with their equity. And they're the most highly levered businesses there are, which is just really interesting to think about as, if you kind of zoom out a little bit at what's going on in the macro. But yeah, I think what's happened and how we got here, you made a great point. You got to look at the cycles and the broader cycles here. And it's, coming out of the great financial crisis, really a lot of slow growth years, and
Yeah.
you're kind of a muddle through, and decent employment, but it was never high growth. And then all
Yeah.
of a sudden, we kind of come into this just turbocharged economy, and lending is just super easy to get. Rates are the lowest they've ever been in history, and it was smooth sailing for a couple of years, right? Things couldn't be better. And if you're a real estate owner, and you sold properties in 2021, 2020,
Yeah.
you made a lot of money. It didn't matter if it was the worst deal on the worst block with every problem, right? And so that is the power of cycles, which I think is a whole other, concept to talk about if we want. But cycles change, and inevitably there's things have to change. And so we've talked a lot about this in our podcast of kind of how do we get to where we are now with the interest rates. And
Yeah.
it's there's a lot of factors that go into it, but a simple idea to understand is we had a lot of changes coming into COVID. They just turbocharged the economy with a massive amount of stimulus. We've actually done some
Trillions.
analysis on historical types of stimulus, right? Because this wasn't the first stimulus that they had done. They did a lot of quantitative easing and other types of indirect types of stimulus before that. And it didn't actually cause inflation, which was really interesting, right? And so if you're a hard money economist, which I'm right into that camp, but you would think any type of stimulus would cause inflation, but it didn't. And even the first parts of stimulus in COVID didn't cause inflation, but then the later parts did. And what we've kind of identified as being one of the kind of critical factors that create this butterfly effect in inflation was capacity and industrial manufacturing capacity. And what happened is all of a sudden we turbocharged all of this, capital resource, right to the consumers, and they're going and
Yeah.
spending it. And at that point, our supply
Yeah.
chain was falling apart, and
Yeah.
we could not meet the demand. So it created this huge ripple effect.
Supply
So
down,
now,
demand way up. Yeah.
yeah.
Econ
So
101, baby.
now,
Yeah.
yeah, exactly. It's a lot. Sometimes people will make it out, and now we're having inflation, which we haven't had to these levels since the '80s, and people forget what it's like, right? And I was born in the '80s, so I'm don't really remember a whole lot of it, but you can read a lot and look historically, and so it's kind of caused a whole new you know world. And
Yeah.
how do we make investment decisions? How do we make business decisions? What do we do? Are we about to hit a massive recession? Are we not? These are all the questions everyone's thinking
Yeah.
about. I don't have a crystal ball, but we're trying to pay attention to a lot of different going on. And obviously the higher inflation has caused higher interest rates. The Fed has committed, to 2% core inflation. We're still a ways off from that. And we're still believers that inflation is going to be higher for longer. We could talk about that if you'd like,
Yeah.
which I think is going to cause interest rates to be higher for longer, which
Yeah.
is going to probably have some pretty, big impacts in the
Yeah.
economy, especially in real estate. So that's kind of where we're at right now.
Yeah.
And, we have lots of different takes on things, but
Yeah.
it's still anyone's guess what happens from here.
Yeah, no, and I like the point you made. We had all this stimulus early on last decade, like 10 years ago, and it didn't seem to create inflation. And that's one thing where, as we have, the modern monetary system that we do now,
Yes.
we have credit. You mentioned like banks are levered at times 10-1. It's amazing, right? So if you come in, well, maybe we should do it the other way around. But if I come in to your bank, Ben, and you say, okay, what do you want? I say, well, I want a loan. And you loan me $100,000 based upon collateral. I can go out and I can spend that $100,000. I can buy that $100,000. I can lever that up. And that money goes into the pockets of other people. And then they have assets. They can go into their bank. They can lever that based upon different things. So, as I looked at it, we had all this credit that had been built based upon all these inflated values, specifically in real estate. It was huge, right? And I'll never forget in like 2008, 2009, 2010, banks said, hey, Chris, you don't have any more lines of credit. So I had hundreds of thousands of dollars in lines of credit that was essentially wiped out. So I might have had $100,000 in the bank and $1 million in lines of credit, and I still had that 100,000 in the bank, but I lost, that $1 million line of credit. So even if the
Sure.
government pumped in another couple $100,000, based, for an individual like myself, we're still down $800,000 because of that credit
Mhm.
creation. So I think, it was kind of like pissing in the wind or pissing in the ocean, really, because, the government was producing all this money. Whereas now we've recovered, land prices have recovered, asset prices are recovered, the stock market's at, all-time highs, commercial real estate is at all-time highs. You have a ton of credit, and then we had all this stimulus. And
Mhm.
what was the statistic? It was like 6 trillion of cash on the
Mhm.
sidelines like 2 years
Yep.
ago,
Yep.
something like that. So
Yeah.
as we came into this year, I was actually on a panel with a mutual friend that we were talking about the deal here a little about a year ago, and he's like, "We're going to have a recession next year," and I'm like, "We have all this cash, and there's like all this credit still." I was like, I just didn't see it,
Right.
personally. Um, and I think it's interesting because, I kind of felt the same way. I was like, I don't really feel like asset prices are going to drop that. We're going to drop that much this year because there was so much cash on the sidelines. Where are we standing now, Ben, with like, liquidity and cash, and not just in this country, but also like around the world?
Yeah, I don't know the global. Like, I mean, the one that we focus most on is the domestic number, and
Yeah,
it's still right now $4 trillion excess
that's a
savings.
massive amount.
This
Yeah,
is excess. This is
yeah,
above the mean historically. So
yeah.
it's not just like everyone's saying. I did some podcasts on this recently. Oh, credit cards are at all-time highs. Credit cards just crossed $1 trillion of balances, and savings rates are declining. Those are actually true statements, but you have to take them in context to the other pieces of data that are very important, right? And so
Yeah.
savings rate is the rate of change, not the actual number. And sure, the savings rate is going down, but the actual absolute number of savings is still very, very high.
Yeah.
And so consumers are still pretty flush. Meanwhile, we've actually had massive wage growth, right? I mean, we've had
Oh
a
yeah.
huge labor shortage the past few years that since COVID, it hasn't been solved. And so, there's
Taco Bell
slowing
paying five
down.
thousand dollar bonuses, $15, $20 an hour.
Oh
It's
yeah.
it's
Yeah.
just entry level. It's wild.
It's
We
just entry
couldn't
level. Yeah.
we couldn't get somebody to help out with our kids for less than $25 an hour a year ago, and it's still like that. It's incredible.
It's crazy. And so I think that's getting solved anytime soon for some systemic reasons, which we could talk
yeah,
about. But
yeah,
I think there's too many things that are kind of pushing against the tidal wave of
yeah,
challenges in the economy to cause a very severe recession. Is it possible we hit a recession? Absolutely. I mean, there's a lot of things that are teetering on the edge, but there's another article in the podcast we just talked about where there was just recently over $200 billion of private equity raised from these big funds to go just they're sitting on the sidelines waiting to scoop up commercial real estate
yeah.
for good
Just
deals.
distressed assets, right? It's like,
Distressed assets, right?
yeah,
They're waiting for the distress to hit. So if you're waiting for the distress to hit, if it hits, it's going to get scooped up, and is it going to cause distress? I mean, the real issue is when the domino hits the other domino, hits the other domino, and it creates this huge effect that's
yeah,
crippling the economy. But if it can kind of be contained, in these little idiosyncratic events, then does it create the massive global recession that we had in 08, 09? I don't know. I'm definitely leaning closer to we're going to hit some form of a soft landing now, but that could change as new data comes out. But just knowing where consumers are at, knowing where wages are at, and even knowing how we have a lot of debt and commercial real estate maturing this year and mostly in next year that
yeah,
are going to be very challenged, right?
yeah,
To finance, to hit the certain covenants they have. Um, but still, banks, they'll likely be into work with the borrowers. They don't want to take back properties. And even if there is deals that go into foreclosure, which we've already been to see the beginnings of, right?
yeah.
They're going to get up. because there's a lot of capital waiting. And that's, I think, a big difference that we have now that we didn't have really, 15 years ago.
Yeah, I think that's a good point. And there's all of these things that people look at. One of them is the yield curve inversion, um,
Mm-hmm.
which normally we see higher yields out into the future as people lock their money
Yep.
up and yields. Um, and then when the yield curve inverts, if you're listening, you're not familiar with that. It's when you have short-term rates that are higher than longer-term rates. So you're actually compensated at a higher rate. And typically, what happens within six months to 2 years, you see a recession in that
Yep.
period. But the yield curve's been inverted for quite a while now, so it's kind of interesting to
Right.
see. And there's different different term bonds and different things that they look at, so you can kind of
Right.
argue about that fact. But yeah, it is really interesting right now, Ben. We're seeing all these different factors floating around, and it just doesn't seem like the foundations are shaking right now. And I think I think it's going to be a couple more years before we see a significant downturn, based upon the same things that you said. The liquidity on the sidelines. We're not as over leveraged as we were before, specifically in the residential market. There's still a lot
Yep.
of regulations that came in. And then the other thing, so I want to kind of take it a slightly different direction. So for longtime listeners, you guys have heard me say this before, but I got into the medical device space because of demographics. And then I got into multifamily real estate 10 years ago because of demographics. And I always go back to the demographics, and I say, like, what it's kind of like supply and demand, right, Ben? It's like, if
Yep.
you have the
Yep.
baby boomers in the 80s buying houses and buying stuff, well, there's a lot of demand, and interest rates go up. Now we have the millennials, and boom, COVID ends, they start moving out of their parents' houses and they're buying up properties left and right. And the baby boomers are retiring and they're moving to areas and buying up properties. So it caused this just massive, massive spike. Um, we have a residential development here locally, and we're moving through putting it all together. The thing is, there's no supply. There's like just no
Right.
supply
Right.
anywhere, and it's really interesting when it comes to that. Do you guys look at demographics? How do you look at that when it comes to? I know we're talking about residential and commercial real estate and different things. How does that play into the equation and your thought process? Today's show is sponsored by Money Insights and their investment optimizer strategy. In my book, I share how I used this same strategy starting over a decade ago to invest my money in two places at one time. This strategy has been used by the wealthiest for generations for estate planning, minimizing taxes, preserving wealth, and increasing stability for their investments. Now you can do the same thing. In addition, you can build a plan to build an emergency fund, pay for college, fund a business, plan for retirement, and ultimately optimize your total financial picture. To find out more information, check us out at the banking link at nextlevelincome.com.
Oh yeah, absolutely. It's one of the most foundational aspects of understanding where are the opportunities, right? I mean,
Yeah.
our tagline that we use at Aspen Funds is, macro driven alternative investments, and the operative word there being macro driven. We want to look at the bigger picture trends
Yeah.
that are driving the investment thesis, because you can have the best deal on, the best market, or the best location in a terrible time in the cycle, right? And you have bad
Right.
debt on the
Right.
property. It doesn't matter what you do. You could be operating this asset just perfectly, but you might lose the property, right? But if you have
Yeah.
tailwinds behind you, you might make a few mistakes. You might, miss a few things. But if you've got, tailwinds behind you, it just creates so much more margin, so much more opportunity. And demographics is absolutely a part of that. I mean, I'm probably preaching to the choir, but you've probably heard the demographics is destiny, right? And there's a lot of layers to what that means. But it's absolutely it's one of the foundational pieces of demand, right? You got supply and demand. You got to look at both sides of it, and demand is a very, very powerful driver. And then the other side of it is supply. We're very probably right now more concerned about supply in a lot of markets, because we are seeing deliveries. And this is not in residential. This is mostly in housing, commercial
Yeah.
housing, that we're seeing massive amounts of supply hitting the market over the next
Yep.
several quarters, the highest we've ever seen in history. And might be alerting to some people. And in some cases, it is going to be alarming because maybe some markets have been slightly overbuilt in the short term. But the
in the
problem
short
is
term. Yeah.
construction starts have massively dropped off because construction costs have been going up. No one's lending, no one's taking the risk on new developments. And so you fast forward, I think 18 to 24 months from now, you're going to be in the exact same spot that we were in a couple of years ago when all these construction starts out,
Yeah.
and we're going to still have some massive supply shortage. On the residential side, I just don't see the supply getting fixed, anytime soon. And it's just, I think people are shocked because they're like waiting for the shoe to drop and they can come in and scoop up
Yeah.
cheaper properties. It's just not going
Yeah.
to happen. There's just not enough
Yeah.
supply, and then you add to the fact, I forget the exact numbers, but I believe it's over 75% homeowners have a mortgage under 4%.
Yeah.
And right now, to go get a new mortgage, it's over 7%. And
Yeah.
depends
So they're
where
not
we're at,
selling.
this is released,
Yeah.
but no
Yeah.
one's selling it because it's going to double
Yeah.
your mortgage cost. And, they're just willing to wait it out. And so it's only exacerbating the supply issue. And then, like we see in these kind of credit tightening parts of the cycle, new developments, new starts, drop off a cliff because it just gets harder to do and to take that risk. So, yeah, I think it's a massive piece of it. I think the other piece of it is supply, and you got to pay attention. That's why we're a little bit less bullish on some of the Sun Belt markets in the short term, just because of some of this massive, I think, short term oversupply.
Yeah.
But if you continue to have demographic trends that are in your favor and people continue to move, to these locations, that will get absorbed and it will over time create more opportunity.
I think that's a great point. So, you have a need for more homes because people want to buy
Yep.
homes, but people aren't selling their homes. So then you have to build new homes, but it costs a lot more to build homes now because land prices are high, labor prices are high, supply prices are high, interest rates are high. So the mortgage gap to rent, I believe today is at an all-time high. Again,
Yeah,
based
it is.
upon when we're recording and when we're airing this. So, it's way cheaper to rent than it is to buy. So then, that's good for us people, and investors that own multifamily properties. But you have all this demand from the supply that was started a couple of years ago when interest rates were at the lowest they'd ever been and
Yep.
liquidity was at a massive amount. But we still need about 4 million multifamily units in over the next 10 years in the United States. So again, kind of that you're peeing into a pretty big pool, So yeah, it's creating some big waves right away, but then those ripples fade really fast. So yeah, I think we're gonna see some short-term shocks here, but if we can ride out the storm here over the near term, it
Yeah,
demographically it looks like we have a really solid decade of demand ahead.
I agree. I mean, I think people have been saying, "Oh, housing's overpriced. Housing's, how to stay in the sun is over." But I don't think it's the case. I think where it's really going to impact the market is a lot of these Sunbelt deals that were purchased, the past couple of years at sub 4 cap rates with very high leverage, very aggressive business plans, have maturing debt coming due with the bridge debt, and seeing slower absorption, right? In a lot of markets,
Yeah.
we're seeing
Yeah.
higher vacancy. And, if you have decent debt and you have a longer term business plan, you'll be fine. You can ride it through because,
Yeah.
the long term case is there. But what it's really going to cause is some of these shocks where they're too aggressive in the business plan. They're planning on getting 20%, rent bumps. But now the consumer has more options and the consumer, has a little bit more buying power, speak in the short term. So I think it is going to cause some, quite a bit of turmoil on some of those properties that were too aggressive. But you're exactly right. I agree. You fast forward past 2 years, probably. I want to be a holder of real estate because I mean it's by far the best inflation adjusted, highest correlated asset class to inflation there is, and over time, it's going to be a winner if you can make it through.
Yeah, no, I agree. So, Ben, you just touched on something. So, inflation, people are still out there looking for yield. We have all this liquidity. Where do you think we go for yield over the next 5 to 10 years? And what assets and what asset classes do you think are going to outperform in your opinion?
Yeah, well, treasuries are paying 5% right now, so that's a lot better than we've ever seen. But
Yeah,
no, it's actually kind of funny because we have a debt fund, and people are like, well, I'm just gonna go buy some risk-free, treasuries. And it's like, don't blame you, but that I don't think that's going to be the case for forever. And what asset classes are going to outperform? I think um, they're the ones that are going to be supply limited and are uh, high demand. And right now we're seeing a few asset classes. Honestly, we love retail. This is something that's very contrarian to a lot of investors, but we're buying these at going in cap rates of sometimes 8 to 9%,
strong. Yeah,
stabilize over double digit. And these are neighborhood retail centers, so they're not big shopping malls. These are kind of right by residential areas, and it's continued to get headlines on Wall Street Journal, other big publications, because um, the values are still there, and there's been no new supply built really in the past 10 years. Is the construction costs are so limiting for these kind of
yeah,
retail centers. So again, we like that where there's some supply constraint and there's still strong demand. Retail is still very, very strong. And probably our number one asset class is industrial, because there's been what we kind of believe a phase two of the industrial boom really being caused by bringing manufacturing back to the U.S. and
yeah.
bringing inventory and reshoring back to the U.S. as well. And so there's been some pretty big fundamental shifts in how companies want to just protect the supply chain, protect different parts of the process of manufacturing that are really going to, America is going to be a winner in this scenario for a lot of reasons. And so we're seeing, we already had all-time low vacancies in industrial. We have, again, there's a lot of supply hitting the market, but that's going to be absorbed pretty quick in most markets. And then again, back to the same issue with limited supply. So we like those. We're still big believers in housing, residential and commercial. I think you got to be smart with the types of deals you're doing right now. And to be honest, just the bid ask spread is a little bit too large for a lot of the deals that we're looking at. So we're actually shifting our approach to actually going lower in the capital stack. All the deals we've looked at the past, really 3 to 6 months, the preferred equity guys were making as much or more than the common equity and taking substantially less risk. And so that's an area that we're shifting our approach to, is to go further down the capital stack, reduce your risk, and still get the same or better returns and protect capital. So I think that's the smart play in this kind of part of the market in housing.
Yeah, I think it's wise, and as we've kind of come out of the last 5 years when we've seen just amazing returns, we're kind of shifting back towards more historical returns when it comes to multifamily. And I mean, when I wrote my book, I talked about 12% returns in that book, and that was an example, but it's just interesting where we got to this point where people thought 12% was really cute, and
Right.
now it's like,
Now,
well, that's not so bad. If you tell me you're gonna get 12% returns for the rest of my life, depending on what inflation is, that ain't too bad.
that ain't too bad for sure.
Yeah. Awesome. Ben, I'd love for you, I mean, we can go on and on here. I'd love for you to touch on one more thing here before we wrap up. We're coming towards the end of the year. A lot of investors, especially high income investors, have heard about or interested or even invested in oil and gas. You have any thoughts on that?
Yeah, well, we're very, very bullish on oil prices for a lot of reasons. Mostly, again, a big supply constraint story. So we've
Yeah.
seen investment into new production over the past 7 years decreased by over 50%, 50. If you think about oil and gas relative to like real estate, it's a depleting resource, right? So every year we're depleting production by 5%. So our total production just goes down by 5% just by producing. And so if we're constantly reinvesting back into more new wells, new drilling, we're reducing supply just automatically.
Yep.
So that's been a case that's been going on for a while, a little bit of time. And meanwhile, the transition to green alternative energy sources is severely hampered by a lot of factors that are going to make it take a lot longer to transition to these alternative sources than, most of these agencies are really being honest with themselves or predicting. So demand is going to stay the same, if not go up by most
Yeah.
predictions over the next 10 to 15 years. You have lower supply. And that's a good recipe for prices to go up, right?
Yeah.
But even aside from that, so that's kind of the price story, but the capital market side is also interesting in that um, most of this production and drilling has been done by big private equity capital allocators, but they've got a lot of pressure the past 5 years to allocate into ESG friendly,
ESG.
environmental,
Yeah.
societal governance standards.
Yeah.
And so they are kind of being penalized if they're not doing that. And so it's shifted a lot of capital. There's been a huge gap in
Yeah.
the market for investing into these types of producing wells. And so we're actually buying producing properties. So these are not just pure drilling programs that have higher risk, but producing, cash flowing properties, and we're buying them at 20% present value. So similar to a cap rate in real estate, 6% cap rate unlevered. That's
Yeah.
with all the decline curves, depletion, estimates built in. That's what we're getting. So from a return standpoint, we think there's a lot of makes a lot of sense from an allocation for your portfolio. But then also you have some great tax benefits, not to get all that, but it's as good or better than real estate in a lot of cases from a tax standpoint. So it's definitely something people should be paying attention to and looking at, especially as maybe they're on the sidelines on some real estate right now. They're kind of waiting to see. It's a great area to look.
Yeah, no, I agree. And, it is interesting. Typically Democratic administrations tend to be good for the oil and gas industry because supply goes down, regulations go up, people stop drilling, or companies stop drilling, I should say. The ESG has been an interesting one as well, as you've had that capital pull back. And, it kind of, I read some of these stories and, it's funny, you used to have the Onion, they have the Babylon Bee, and you read stuff like California mandates that all new cars sold need to be electric vehicles by, was it 2030 or 2035? And then the next week they say, don't plug in your electric vehicle because you might crash the grid. And I'm like, wait a minute, is this a joke? And then you read it and you're like, no, it's not a joke. This is actually real. And then the chief of fire comes out, and I may be mixing up his title here. He comes out and he says, oh, no. You should charge your electric vehicle because if there's an emergency, you need to drive it, you need to charge it. So I think you have the tail wagging the dog when it comes to some things. And for those that know me,
give me a quick example.
Yeah, please,
John Kerry, he's in the Biden administration, running the energy side of things.
Yeah.
And he earlier this year was telling the CEO of BP, who's planning to do $1 billion of investment into new drilling, he said, no, you shouldn't be doing that. We need to focus on, renewable energy, and you should be drilling that. So basically a little bit, right? And they've threatened these kind of other big windfall taxes and other things. And then as well, if we reduce supply, go up. Well, then Biden comes out and is bashing the oil companies for not producing more and hurting the consumer because they're not producing enough oil, and gasoline prices are higher. So it's like, well, which is it?
Yeah, it is interesting. And look, I'm an environmentalist. I want, I would love it if we had
absolutely
energy, but we had, we've kind of had this whipsaw effect. And, I think Nixon had a plan. It was Nixon to be energy independent by 2000 based upon nuclear energy, but those things were shut down due to different things. Yeah. So there's a lot of exciting technology there. I'm a big fan of all of the above. I'm an optimist when it comes to technology and these sorts of things. Yep. But I'll throw one last thing out there to kind of put a bow on this. Our emissions in the US are way down over the last 20 years. And actually, the greening of the planet has increased 20% over the last 20 years. You heard me right. It's more greener than it used to be. And it makes common sense. It's common sense if you think about it. If you put carbon dioxide into the air and plants feed off of carbon dioxide, they're going to grow better. But I think a lot of people don't realize that the planet it's either healing or it's getting green. I hate, pollution is a terrible thing, but one of the reasons that we've lowered emissions so much is we've shifted away from coal to natural gas, which is clean burning,
Yes.
which
Yep.
comes from fracking. So, all these things interplay. We need petroleum products to produce things like solar panels that I had on my house, like the battery that's in my wife's plug-in hybrid electric car. So, so you can do your part. You can help produce energy. You can help the United States
100%.
be more energy independent, and you can get a tax benefit with oil and gas, which I've personally done myself. Ben, I can't wait to see you here in the next couple of weeks when we get together and we can maybe have a drink and continue this conversation. But until then, how can people get a hold of you? How can they learn more about what you guys are doing at Aspen Funds?
Yeah, I appreciate that. And if you like podcasts, we have a podcast called Invest Like a Billionaire. And if you're interested in kind of the investment side of things, aspenfunds.us is our private equity company.
Awesome. And I'll also have a link in here for your free economic report that you have on your website. Ben, it's been fun. Thank you so much for sharing your insights with our audience today.
All right. Thanks so much. This was really fun.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.